All right, let's get right into it. Today, we're pulling back the curtain on a concept that's been shaping our economy for centuries, but you know what? Most people have never even heard of it. It's called the Cantillon Effect.
Have you ever wondered about this? It's a question that feels more relevant than ever. When you hear about central banks creating trillions of dollars out of thin air, it just doesn't feel like that money reaches everyone equally, right? In fact, the gap between the wealthy and everyone else just seems to get wider. Well, it turns out there's a 300-year-old explanation for exactly why that happens.
And that explanation is the Cantillon Effect. At its heart, it's a really simple but incredibly powerful idea. When new money gets created, who gets it first matters a lot. It's not just about how much money is printed, it's all about the path that money takes as it flows through the economy. So to really understand this, we've got to go back, way back. We're going to look at how an Irish banker living in Paris stumbled upon one of the most important secrets in all of modern finance. This is our guy, Richard Cantillon. Now, he wasn't just some academic theorist. No, he was a high-stakes financier who made an absolute fortune during a massive speculative bubble. And this is the crucial part. He got out right before it all came crashing down. This experience, being right in the eye of the storm, gave him a totally unique insight into how new money could warp an entire economy. And what's wild is that his idea was almost completely lost to history. He wrote his masterpiece back in the 1730s, but it wasn't even published until after his death. Then it just sat in obscurity for over 100 years before being rediscovered. It really wasn't until the massive money printing that happened after the 2008 financial crisis that his theory just exploded back into the mainstream conversation.
Okay, so to really get this concept, we're going to use Cantillon's original analogy. It's a simple little blueprint that perfectly illustrates the core mechanics of how new money ripples through a society.
Cantillon used this brilliant river metaphor. He said, look, doubling the amount of money in an economy doesn't just make everything twice as expensive overnight. It's not that simple. Instead, he said, new money flows like water. It winds around, it pulls in certain areas first, before it slowly, eventually reaches everyone else. So here's exactly how that flow works. Imagine a new gold mine is found. Step 1, the mine owners and the miners, they get paid first. They're rich. Step 2, what do? They go out and spend it. But not on everyday stuff. They buy luxury goods, fine wine, fancy clothes. This immediately drives up the prices of those specific things. Step 3, now the merchants selling those luxury goods are flush with cash, and the ripple continues outwards. But here's the kicker. By the time that new money finally trickles all the way down to the average worker, the prices of everything they need to buy have already been bid up by all the people who got the money first. So their purchasing power has actually gone down.
Okay, so that was the 18th century. How does any of this apply to our world today? Well, the gold mine is gone, but the principle is actually more powerful than ever. It's just been replaced by a much more efficient machine. Back then, the entry point for new money was something physical, something you could touch, literally a hole in the ground where gold was being pulled out. Today, that entry point is an institution. Central banks, like the Federal Reserve, create new money digitally, basically with the stroke of a keyboard.
And this is the absolute key to understanding the modern Cantillon effect. The first receivers are no longer miners and landowners. Today, they are a very select group of massive investment banks, called primary dealers, along with their biggest clients, like hedge funds and giant corporations. They are the modern-day mine owners.
So what exactly are these primary dealers? Well, think of them as the gatekeepers of new money. They have a special, privileged relationship where they trade directly with the central bank. When the Fed wants to inject money into the system, it buys assets, like bonds, from these banks. This means they get first access to billions in brand new cash at the lowest possible cost before anyone else even knows what's happening. And they immediately put it to work in the financial market.
So, this brings us to the real-world consequences. We've gone through the theory, now let's look at the actual impact this has on Wall Street, on Main Street, and that ever-widening gap between them.
Just look at this chart. It's staggering. In the decade after the 2008 crisis, a period of absolutely massive money creation, the stock market, you can see it here with the S&P 500, it just exploded. It went parabolic. And meanwhile, what happened to wages for the average person? They barely budged in comparison. The new money flowed directly into financial assets, not into paychecks. And here's why that divergence is so incredibly important. When the stock market booms like that, it doesn't lift all boats, not even close.
The wealthiest 10% of households own over 90% of all stocks. So a policy that is designed to pump up asset prices is, by its very nature, a policy that funnels wealth directly to the people who are already rich. And for a recent, completely jaw-dropping example, look no further than the AI boom. You have a company like NVIDIA seeing its market value soar by trillions of dollars in an incredibly short period of time. Now, this wasn't just about cool technology. It was a perfect example of a tidal wave of capital concentrating in one very specific sector, creating a speculative frenzy.
Let's just break this down. At the height of the boom, some projections showed that investment in AI was responsible for almost all U.S. economic growth. Big tech firms took on enormous debt to pour money into just a handful of companies. It's a textbook case of the Cantillon Effect distorting the entire economy around one single hot sector, what many economists would call a classic bubble.
So this all leads us to a fundamental and maybe uncomfortable question. Is this system fair? Let's look at the core debate here. And what, if anything, could even be done about it?
Okay, so you basically have two competing views on this. On one side, you've got the mainstream idea that, in the long run, money is neutral. It's just a veil. Printing more of it only leads to higher prices, and eventually the real economy just sorts itself out. But on the other side, you have the Cantillon view, which says money is never neutral. Because it always enters at a specific point and flows unevenly, it permanently changes the structure of society. It literally changes who's rich, who's poor, and what our economy even decides to build.
So if this is a problem, what are the potential solutions on the table? Well, some people suggest we should just bypass the banks entirely and give new money directly to all citizens, so-called helicopter money. Others propose higher taxes on the massive gains people make from this asset inflation. You also hear about reforms to make sure small businesses can actually get credit, and then some argue for a complete overhaul, like going back to a gold standard to put a hard limit on money printing.
And this all brings us to the final and most important question. What Richard Cantillon showed us 300 years ago is that the way we create money is not a neutral technical act. It is a choice. It's a choice about who benefits first and who gets left behind. So, if the rules of the game will always produce winners and losers, the real question we have to ask ourselves is this: what kind of rules should we choose?